Hello everyone, let's do one more example of the preparation of a statement of cash flows using the indirect method, this time for Tennessee Sweet Tea. And what we have to do first, as always when you're setting up your statement of cash flows, is go and find the changes in all of your current asset and current liability accounts, and then find all of the different accounts, again on either your balance sheets or your income statement, which would have an effect on the cash flows of your company during the period. And all this information has been consolidated into these charts on the side over here for ease. So let's go through and start by finding our change to our current assets. We are reporting cash of $50,000 at the end of the current period. We had $20,000 in cash the last time we reported at the end of 2017. That is a $30,000 increase to cash in total. What about accounts receivable? Well, we had $15,000 of accounts receivable at the end of 2018. When we reported during the previous year, we reported $10,000 of accounts receivable. So Tennessee Sweet Tea's accounts receivable balance increased by $5,000 during the period. And the same is true for their inventory. They had $20,000 at the end of the current period. They had $10,000 at the end of the prior period. That is an overall increase of $10,000 over the course of the 2018 business year. For supplies, they had $7,000 worth of supplies on hand at the end of 2018. The last time they reported at the end of 2017, they were reporting $15,000 worth of supplies. That is a decrease of $8,000. And with that, we are through all of our current assets, found the changes to all of those accounts. We know the changes to our non-cash current assets, which we're going to have to use to make our adjustment to net income. And we know the overall answer we're going to have, which is our net increase to cash of $30,000. Well, we're not only going to have to adjust net income by the changes of our current assets, but our current liabilities as well. So let's go and find the change to current liabilities. And our change in current liabilities is that we're reporting $12,500 at the end of the current period. At the end of the prior period, we reported $20,000, which means Tennessee Sweet Tea's accounts payable decreased by $7,500 during the 2018 business year. For accrued liabilities, that increase was even more. It went from $25,000 we were reporting at the end of 2017 down to the $12,500 we're reporting at the end of 2018. Our current year, that account decreased by $12,500. And now that we have all the changes in our current assets and current liabilities in place so we can use them for our adjustments to net income, we should figure out where these other provided items are going to go. And the first item that is on our list down here is a depreciation expense of $11,000. Well, depreciation will have decreased our net income, but not decreased our cash flow, which means we need to adjust for that difference in the adjustment section of the operating portion of our statement of cash flows. So depreciation expense, like all non-cash expenditures, goes into your operating section. We have the cash proceeds from equipment sale. And again, as a rule of thumb, the best way to know what section to put it in is determine what type of account you're receiving cash from or using it on. And in this case, that is equipment. And equipment is a non-current asset. It's PP&E. And all non-current assets will be listed in the investing section of your statement of cash flows. Underneath this, we have a loss on equipment disposal. And you see equipment right here, you want to put that in investing as well. But this isn't actually cash changing hands from the sale of this equipment. This is the accounting concept, the loss that we are reporting on our income statement, which ultimately affected our net income. So if you want to think about it this way, the loss or gain on any type of disposal of a non-current asset means that it doesn't go in the actual investing section because it's not related to the cash that actually changed hands. It's more related to the effect that that sale had on your net income. In this case, that loss would have lowered our net income, but it did not change the amount of cash we actually received. We still got $21,000 for selling that equipment. So we're going to have to make an adjustment for this in the operating section of our statement of cash flows. We have the issuance of common stock for cash in this case, and that is for $25,000. Well, that is something that our business does to raise money. And when you raise money, it is to be said that you are financing your company's operations. So that's going to go in the financing section. And common stock is an equity account. You can also look at it that way. All equity accounts always go in the financing section as long as cash is involved in the transaction. We had the cash payment for dividends. Well, we paid $15,000 worth of dividends. That is a withdrawal account, and like all withdrawal accounts, that's going to go in the financing section because that is a necessary cost of issuing your common stock. So they're intertwined together. They need to go into the same section. Net income is where we start everything off with. That is what we are going to do in the operating section. We are going to adjust our net income to the actual cash which was either provided by or used for our operating activities during the period. The next item on our list is the acquisition of land via issuing common stock. So in this case, we're getting something and we're giving up something, but neither of those are cash. We're getting the land, but instead of transferring cash for it, we're going to transfer common stock, which means that is a non-cash activity. We had the cash purchase of furniture up next. Well, cash is changing hands here, so it needs to go into the main body of our statement of cash flows. And what are we spending the cash on? Furniture, which is a non-current asset. And like all non-current assets, like equipment up above, it's going to go in the investing section. By investing in new furniture, we are improving the long-term profitability of Tennessee Sweet Tea. The next item we have is the settlement of a mortgage via preferred stock. And just like acquisition of land via common stock above, I don't see any cash changing hands in this transaction. We are getting out of a debt, but instead of paying cash to get out of that debt, we're going to give whoever holds our mortgage something else. We're going to give them shares of our preferred stock, and therefore we're no longer indebted. We don't have to make payments on it. And we're not making any payments means that is a non-cash activity. And then lastly, we have the cash receipt from the issuance of bonds. So we issued $10,000 worth of bonds to investors during the period. They bought them from us. They gave us 10 grand. We raised some money to finance our activities. So bonds are a piece of long-term debt. And for all pieces of long-term debt, it should go in the financing section just as long as cash actually changed hands within the transaction. In this case, it did. So now we get to put together our statement of cash flows. And all of the accounts I have are already filled in over here, so we can just run through here. Net income was reported as $10,000 for the period. According to our information, let's put that in the right-handmost column. We had a depreciation expense of $11,000 during the period, but that depreciation expense did not actually lower our cash flow. It lowered our income, but not our cash flow, which means we need to add that back in. We had a loss on the disposal of equipment, and the loss on the disposal of our equipment decreased our net income, but it did not decrease our cash flow, which means to adjust our net income to the actual change it caused in cash, we need to add that back in. Then we can move on to the changes in our current asset and current liability accounts. We have an increase in accounts receivable. Accounts receivable went up by $5,000 during the period. Well, if our accounts receivable is going up, that means more of our customers are paying with credit as opposed to actually giving us cash, which means our cash flow has to be going down. We had an increase in inventory of $10,000 during the period. If our inventory increased by 10 grand, we must have bought more inventory, which means our cash flow has to be going down. Then we had a decrease in supplies of $8,000. If you have a decrease in supplies, that means you bought less supplies, and if you bought less of something, you should have more money still in your bank account, which means that decrease in supplies, buying less supplies, caused our cash balance to increase. We held on to that money instead. So for all of your current assets, do the opposite of the change. An increase to a current asset decreases cash flows and vice versa. On to our current liabilities, we had a decrease in accounts payable of $7,500, which means we must have paid off $7,500 an additional debt this year. And if we're paying off more debt, that means we're spending more money to finance that debt, and our cash flow has to be decreasing. We have a decrease in accrued liabilities. Our accrued liabilities are decreasing by $12,500, which means we paid more on interest, on our utilities, on salaries during the period instead of owing it to people. And since we paid more of those costs instead of saying IOU, our cash flow has to be decreasing there as well. So what is the total of these adjustments? Well, we just add up all the numbers we just put in the left-hand column, and we find that our decrease overall caused by our adjustments is $15,000. So yes, we had net income reported of $10,000 during the period, but we need to adjust that down 15 grand. So what we're saying here is our normal course of operations for the 2018 year actually caused our cash balance to decrease by $5,000. Operations caused us to spend more cash than we brought in during the period. Hopefully this was offset by something else, and we know that it needs to be because we had a positive increase to cash. So hopefully somewhere in these investing and financing activities we're going to be bringing in some money. Let's figure that out. For our investing activities, we had two items: the cash proceeds from the equipment of sale, we determine that guy goes there, and the cash purchase of furniture. So the cash proceeds from the equipment of sale, going in the left hand column, was $21,000. We got that money for selling that equipment, which means our cash flow has to be going up. For the cash purchase of furniture, we are spending that money, which means our cash flow has to be going down. And in total, the net cash which is provided by our investing activities, our activities related to our non-current assets, is an increase of $15,000. And if you think about it, it makes a little bit of sense. If you sold that equipment for 21 grand, immediately turned around and bought furniture with $6,000 of the money you got from the equipment sale, how much money from that sale would you have left over which you could put in your bank account? $15,000. For financing activities, we had three items. We had the issuance of common stock, the payment of cash dividends, and the cash receipt from the issuance of bonds. So for the cash receipt from stock issuance, we sold that stock in this case. And since we sold it, we got the money from our investors, which increased our company's cash flow. So that $25,000 we got from issuing common stock should be increasing Tennessee Sweet Tea's overall cash balance. We paid dividends to the owners of that common stock afterwards in the total of $15,000. Well, if we paid $15,000 worth of dividends, that means that our cash balance in our account has to be going down because we're taking money out of our account to give to our owners. There's a decrease to our cash flow of $15,000. And then lastly, we had the cash receipt from the issuance of bonds. We sold $10,000 worth of bonds to investors, and they gave us the $10,000 to buy those bonds. And since they're giving us the money, our total amount of cash has to be going up. So in total, if we sum this up, that is a $20,000 increase to our overall cash balance, which was provided by financing activities. The amount of money that we brought in from issuing stock and issuing bonds more than offset the amount we needed to pay in dividends. We have $20,000 left over from all of the normal things that we do to obtain financing. So what is our net increase or decrease in cash for the period? Well, to find that particular amount, all you do is you sum up the total for your three different sections. We used $5,000 for operating activities. We were provided $15,000 from investing activities, and we brought in another $20,000 from financing activities. And if we total those three numbers up, we come up with a net increase in cash of $30,000, which again was exactly what our balance sheet said to us at the beginning. We knew that was a number we're working towards, and we got there. So our statement of cash flows is valid. It's good. We only have a couple more things we need to do. Firstly, we need to report the amount of cash that we had on hand for each of our last two balance sheets. So our cash balance on 12/31/17 would have been what we reported on our 2017 balance sheet. That was $20,000. Our cash on hand as of 12/31/18 would have been the $50,000 that we're reporting during the current period. And that difference between those two is in fact that $30,000. So now our users have that right up in front of them. And then next to that we have our non-cash activities for the period, of which we had two. We had the acquisition of land via common stock, and we had the settlement of a mortgage via preferred stock. So if we acquired land by issuing common stock, we got $10,000 worth of land that we didn't have to exchange cash for. But that is still a pretty significant activity, acquiring a $10,000 piece of land. And a keen-eyed investor might see that spike in land on their balance sheet, realize that land as a non-current asset should go in the investing section, not see here and say, hey, what's going on? So we should easily let them know that we acquired that land by issuing common stock and put it on our books for $10,000. We settled a mortgage by issuing preferred stock. Well, we issued $25,000 worth of preferred stock to settle that mortgage. So we take that $25,000 and we bring it over. Again, our investor would look at our current balance sheet, see that our mortgage is gone, see that our preferred stock has increased greatly, and not seeing any of those things listed in our financing section, would want to be assured that those two are in fact intertwined. And to make it easier on them, we put it right here. We settled the mortgage by issuing preferred stock. It got us out of $25,000 of future payments. And if we sum that up, in total, we're going to have significant non-cash investing and financing activities of $35,000.